Hey guys, what is going on? Welcome to the video. So in this video, I want to talk about what I personally do when there's market volatility. Maybe there's a big dip going on, lots of fear about a correction or a crash. I'm going to be talking about what I personally do in these situations, some tips, some things to follow when you're in these situations and you're trading or you're investing, and just what not to do and what to do. I'm going to be talking about a couple of tips that I have for that. And I'm filming this video early in the week that ends on July 23rd because I'm going to be out of town late this week and into next week. So I want to get this Sunday video out to you guys to keep the upload streak of the weekly uploads on Sunday alive. So by next Sunday, we'll be back to the normal top 3 stock videos on Sunday. Alright, so first off, getting into it, during this market volatility, while there's dips and everything like that, there is a lot of trading opportunities because there's a lot of trading volume, the markets are volatile, big swings up, big swings down, there's a lot of that going on, so that brings up some big day trading opportunities, some big swing trading opportunities, whether you're playing the bullish side or the bearish side. Personally, I usually play the bullish side just because the market will always be skewed bullish. The stocks are always going to go higher in the long term, so it does give you a little bit better chance. I personally like buying oversold dips, but there's a lot of traders out there as well that like playing the downside of the position, shorting, playing put options. So there's a lot of reward potential both ways trading in a volatile market. So with big reward potential during all this volatility also comes a lot of risk potential. These big swings up and big swings down can be great if you're on the right side of it, but horrible if you're on the wrong side of it and you could lose a lot of money quickly. So first off, what I do in these situations, I do usually trade these situations, a lot of day trading. So during these situations, I always have a stop loss and I always respect those stop loss levels because if you don't have a stop loss and you're trading in the short term, you can get screwed very easily and end up bag holding position you just want to be in short term and did not want to end up in the long term position. So in my opinion, you should always have a stop loss if you're trading short term in a volatile market like this. So I always have a stop loss level. My risk is always defined in getting into any position that I get into. So that way it takes the emotion side out of it. If your stop loss hits, it is what it is. You're already prepared to lose that amount of money when you got into the trade and set your stop loss. I personally usually use mental stop losses over physical stop losses. Reason because algorithms, which the majority of trading is done with now, they are trained to hunt down your stop loss levels if they're a shorting algorithm. So an example of this is all that news about Robinhood selling all their users' info to Citadel. Now with this, Citadel has that information. They know where Robinhood users are setting their stop losses. Their algorithms can then short the stock all the way down to where those heavy stop losses are at, hit those stop losses, and then cover right after all those stop losses trigger, therefore screwing over any retail investors that were with Robinhood and giving those algorithms the best cover for their short and the most profitable. Okay, so anyways, that's my strategy with short-term trades. Always have a stop loss, risk is always defined, always play it safe rather than sorry. You don't want to bag hold a stock that you're in short term and end up holding long term, hoping to get back what you lost. You never want to be in that situation. So what I do with long-term positions is I don't worry about stop losses, I don't worry about anything. My long-term positions are based off of fundamentals and what I think the company will be out years in the future. I'm not too worried about short-term price action. If there is big dips, that to me is just a buying opportunity. So what I do is I focus on my high conviction long-term plays. I average into those and I always leave some cash on the sideline, whether that's 10%, 20%, 30%. Currently, I'm sitting with about 25 to 30% cash in my portfolio. During this dip, if it ends up dipping for weeks, I may get down to 20%. If it dips for a month, 2 months, I'll probably get down to 10%. I personally would not feel comfortable having less than 10% cash, so I always want to have that 10% cash plus at all times. That's just my personal preference. Other people can deploy all their cash and be perfectly comfortable with not looking at the market. Me personally, I like to be averaging down always on my long-term positions. A good way to think about it is just stocks are on sale at that time. You're buying them at cheaper valuations. That means more reward potential in the future. So why would you not be buying during these times? You should always be buying these dips and never panic selling dips unless your thesis has changed or you are not in that position for the long term. Okay, so that's what I personally do during these dips and market corrections. Always buying those dips for my long-term positions, respecting my stop losses and risk levels for short-term positions, while also trading off the volatility, but doing it in a smart way. Okay, so getting into some tips that I have for anybody who is newer to the market. Maybe you started trading and investing a year ago, maybe a year and a half ago, when the market has pretty much gone up in a straight line. The number one tip that I have is do not listen to financial media. Do not be reading stock twists, Yahoo finance boards, financial Twitter, Reddit, any of those social platforms. Reason because there's always people spreading false information. These people on those message boards online, they're not your friends, they're not here to help you make money. Their opinion is wherever their money is at. So if they're short the market, they're going to be saying the market's crashing, it's going to go down 20% from here. And if they're bullish on the market, they're going to be saying this is just a quick dip, we're going to go hit new highs in a week. All that stuff, maybe they're right, maybe they're wrong, but whatever they're saying, they're in it for themselves, they're not your friends, they're not here to help you make money. A perfect example of this is Jim Cramer on CNBC. Jim has a lot of hedge fund connections. He moves stock prices with what he says. A couple quick examples. Jim was huge on DD, ticker symbol DIDI, and then he was bearish on DD after the bearish news came out. He was also huge on Coinbase. He was tweeting Coinbase to $475. He has these hedge fund connections. He's helping his buddies out who have a ton of money. Believe it or not, a lot of these people are in it for themselves. Jim, he has good advice sometimes. Sometimes he has terrible advice, and that is what has proven mostly in the past year. Just because they're knowledgeable in the space does not mean they're right. Another example is Michael Burry. This man has been calling for a crash for years now. Maybe he's right this time. Most likely he's not right this time. Will he be right at some point? Probably so, just because the market will crash at some point. Whether that happens this year, whether that happens 5 years or 10 years out, he's going to be right at some point. But he's been calling this crash for decades, spreading a ton of fear and uncertainty. Once again, these are just these people's opinions. Just because they're smart and have made a lot of money in the market does not mean that they're going to be right this time. Okay, so the next tip that I have is think about investing like you're buying businesses and you're not buying stocks. You're buying businesses who are cash flowing. Either you're investing in the future cash flow that the business is going to be making profit with, if that's a growth stock, or you're investing in the cash flow and the dividend right now. Whatever you're doing, think about it like you're investing in a business. Always know your numbers, always have a thesis behind it. And if you think about it this way, you will not be one who panic sells during these market dips and sells when stocks are low. For example, I have conviction in all stocks that I'm in. I do not blink twice when stocks are down if it's a long-term position for me and I plan on holding years anyway. That is me personally. I'm confident in my positions. Now let's say the opposite of this. Let's say that you are watching me right now on this YouTube video and I'm talking about some random stock that I like and I'm buying right now. Maybe I'm right on this, maybe I'm wrong. I personally have conviction. If you do not have your own conviction on the stock, if you do not have your own conviction on the trade, you should not be in that trade. On this YouTube channel, I throw out my ideas, what I'm personally doing. That does not mean that you should do it. I've been right a lot of times this year, and I've also been wrong a lot of times this year. Not every pick will play out, but what's going to differentiate you for being a profitable investor and trader and a non-profitable investor and trader is your conviction level, whether you do your own research and due diligence and have your own thesis on the stock. That is what's going to separate you from others. And so you're not one who panic sells on dips and chases FOMO and buys when the stocks are going up. You do not want to be in that situation. You want to buy where you have conviction on dips and then sell when stocks are high. The next tip that I have for you is just be patient. I know it's hard to look at your account when you're down thousands of dollars in a single day, but at the end of the day, just realize that stocks will always go up more over time. Indexes will always hit new highs. If you're investing in good companies, there's a great chance that those will hit new highs in the future. Even if you are just going through a short-term dip and losing money in the short term, just have conviction, be patient, and have trust in the process for the long term. And if you're uncomfortable holding single stocks in the dip because nothing is guaranteed with single companies, there could always be bad news coming out or whatever. If you're not comfortable with that risk, you can always cut your loss, take the tax write-off for your taxes, and invest in ETFs. Because when you're investing in ETFs, that gives you the peace of mind that you know for a fact those will hit new highs in the future no matter what, whether that takes a couple years from now or whether that happens in a couple months. Indexes will always hit new highs. So let's say the S&P 500 is down 2% today. You're essentially buying that 2% dip and guaranteeing yourself 2% for when the next high hits, getting back to new highs. So think about it that way, you can make investing mindless, make it easy, and have confidence when buying stocks when they're on dips and indexes. So the final tip that I have is be systematic when trading and investing. Have a plan going into every single day. Personally, I almost always know what trades I'm looking at the next day, what investments I want to make, what positions I want to increase, what positions I want to sell. Being systematic with your trading and investing takes the emotions out of it, which is the biggest downfall for many investors and traders. Take your emotions out, be systematic, plan what you're going to do ahead of time. Let's say you don't want to have a position more than 10% of your overall portfolio, then don't let it be that. Maybe average in slowly, maybe add 1%, then another percent the next day, and make sure not to cross that max amount of position sizing that you want to have. Don't over-allocate yourself to one asset if you're not comfortable with risk. Planning ahead of time how much capital you want to allocate, either to aggressive positions or conservative positions. what your risk tolerance is. Planning all this ahead of time will help you so much emotionally during all this, so you're not going all in on the first dip that you see and then screwed when the market dips more. Be systematic, average in slowly, leave cash on the sideline, have a plan going into every trade and investment for position sizing and whatever you want to do and your goal with that investment or trade. So that's all I got for you guys today. I appreciate you watching. I hope everybody's doing well in this current market. Make sure to continue to trade smart, and I'll catch you guys next time. Let's get rich.